Hello. Welcome to Dancing with the Stars. Thanks for coming. This is the private equity thing. You're not here for that. You're in the wrong place. And my whole role here tonight is to introduce some of these people who are going to be speaking for the next hour or so. I think everybody knows Professor Scotten, so there he is. All right, so in order of appearance, David Lee, who is a private equity partner at Munger. Rick Madden, who is a private equity partner at Skadden Arps. And I assume private equity means the department as opposed to an equity partner. Although both. I made that assumption. Then we have Ken. Ken Firtel, Managing Director at Transom Capital. And an alumni. And Chris Taylor, who's a Senior Associate at Tennebaum Capital. So without further ado.
Thank you, Professor Tesla. Yes, everyone, welcome. Good evening. This is our second event of the semester, so we're actually happy to have you. We keep providing food and drink, hoping that we keep coming. So there is another event coming up in November on real estate, so we invite you to that, and there'll be more announcements on that. But let's proceed for tonight. We're dealing with private equity. We have our esteemed colleagues here, who I'll let them do all the talking. My job is just to moderate and keep the conversation flowing. But what we plan to do is just give several PowerPoint slides. We're going to ask each of the speakers to speak to one of the slides, but then I'm going to invite the other speakers to participate in the conversation as they want to add things that will help you guys out. And then we will keep most of the time at the end available, or a substantial amount of time available for questioning, because we want you guys to be able to ask those questions, both for business-oriented questions and legal-oriented questions to the panelists. So we'll get started. The first slide here, we're going to ask David to start to talk with. And again, please, the panelists, you guys can add what you guys want as we go forward.
Sure. My name is David Lee. I'm a partner with Munger here in LA. And I form private equity funds and other funds for a living. I thought I'd start today by just asking the question and answering the question, what is a private equity fund? And in its simplest form, it's basically a pool of money, pool of capital. It's a pool of capital that's typically organized as a Delaware or Cayman Island limited partnership. Sometimes it's more than one vehicle working together. The money for the pool is provided by third-party investors, we call them LPs, limited partners in the vehicle. The LPs tend to be institutional investors, public pension funds, private pension funds, insurance companies, endowments, foundations, basically sovereign wealth funds, basically entities with a large amount of capital that they want to put to work through private equity. Some high net worth individuals as well. The fund in turn is run by fund manager, people like Tennebaum and Transom. They range from small firms with a couple of investment professionals to the large buyout firms that we all know about, Carlisle, the world, Oaktree Capital, KKRs, and the like, and then everything in between. And then they basically, these fund managers then take this pool of capital and they invest in accordance with a private equity strategy, which is primarily putting capital, equity type investments or equity investments in what they call portfolio companies, the company. So kind of big picture-wise, in the simplest form, that is a private equity.
Can you speak for a few moments just to the formative process? What gets the ball rolling in any specific opportunity?
Sure. Private equity funds are organized under what we call a closed-end fund structure. And as a result of that, it has a definite fixed life. It's organized in a way where the investors come in early on in the process and commit to invest. And then throughout the process, you're typically not allowed to withdraw from the fund, and they're relying on the fund manager to invest the money, realize the investment, and then ultimately get the money back from the sale and the money investment. So a fund typically has there's typically three stages of this fund. There's a fundraising period, which is about maybe anywhere from a few months to maybe up to 2 years, where the fund manager goes out, finds potential investors to commit money to the fund. There is then an investment period where the money that's committed to the fund is then actually invested, and this period is about maybe 5 to 6 years plus or minus. And then there is the runoff period, the management exit period, where the fund manager takes the companies that the fund has invested in, nurtures it, tries to enhance the value of the company, and ultimately sells it. Now these three periods are not necessarily interesting periods. There's a fair amount of overlap. You could be on the one hand fundraising while investing capital at the same time. You could, while during your investment period, also be selling companies that you may have invested in earlier on. But ultimately, over the course of about 10, 12, 15 years, you start from basically an empty vehicle where investors have committed cash to a vehicle that has, over the course of time, bought a number of companies and then ultimately selling it and then taking that money and then returning it to the investment, and hopefully in the process you made a lot of money.
Ken and Chris, if I could ask you guys to speak for a moment to the business perspective in the very formative stage of these investment opportunities. What are you thinking about from the business perspective? I mean, how do you approach the attorneys? Do they come to you? What's the process that you're doing from the business side?
Yeah, I think when we formed our fund in the beginning of 2008, so it was a interesting time to form a private equity company, just given what was happening in the economy. A lot of the issues that we dealt with, we used O'Melveny & Myers as our fund formation attorneys. Sorry. A lot of what we talked about with the attorney was what Dave will get into in terms of the carry percentage and the management fee and stuff like that. But it was also a lot of other stuff about offsetting certain fees and bearing certain risks and key man events and stuff like that if someone leaves. It was a lot of the internal kind of the general partner. The way it's formed is there's a limited partnership that the investors put their money in, and there's a general partner that controls the fund, and that's me and my partners are the general partner. So there's a lot of interdynamics, and we spend a tremendous amount of time actually on our general partnership agreement that what if you get in fights, what if you leave, how do you allocate the profits and the fees that come up. That was one of the actually more time consuming of the conversation.
I guess from our perspective, our fund, so, while the traditional private equity fund is more, and what you guys probably think of in private equity, is buying out companies, what my fund does is, we can invest in equity, but we largely focus on the debt of companies. And so instead of just making an investment and then exiting at the end and giving the money back to the investors, we are able to recycle the capital several times over the course of the fund life. And so when we're setting up a fund, it's not so much, well, we're gonna make investments over 3 years and then we're gonna hold those investments for 2 to 5 years and then sell them. It's we're gonna be investing, selling, using the money to invest again. So it's a little bit tricky in terms of when you give the money back to the LPs, because we'd obviously like to recycle it as many times as possible to juice the IRRs. So we've got now 7 different funds that we manage at Tennebaum, and some are more discrete where we'll have right now at least thinking about the investment period and then the total hold period is one of the big decision factors of setting up the fund. So our most recent one was raised in 2011, end of 2010, early 2011, and that one has a 5-year investment life and a 7-year total life. So we've got 5 years to recycle, and then once we exit investments after 5 years, any of that capital goes back to the LPs. But then we also took one of our funds public for the first time. So typically we had a $10 million minimum to get into the fund, but earlier this year we took one existing fund public into what's called a BDC, Business Development Corp, And so, anyone can buy shares in that, just like a normal publicly traded stock. And that one essentially is forever capital, where we'll be investing that money, hopefully, for the rest of the firm's history. That's the real ideal capital situation, from our perspective, given that we can just keep on rolling it over, and when investors want to get out, instead of having to finish the fund and start a new one, we just, they can sell their stock and other people will cycle in.
Let's go into investment strategies. Ken, if I can come back to you, speak to this first.
Yeah, sure, of course. Okay, let me actually ask, if I could, a broader question. How many people know what private equity is? Okay, good. You're ahead of me when I was in law school. So, so at a really, really high level, for those of you who don't know, private equity basically is just a term for taking private money and investing it into assets, i.e. companies, at a really high level. That strategy can go across a bunch of different sort of continuums here. The most common strategy is what people call LBOs, leveraged buyouts. There's growth capital, and then there's sort of a subset of these are distressed and special situations, which Chris will talk about in more detail. I won't go into, but leveraged buyouts is sort of what you kind of see in the movies. Pretty Woman and the like, where they come in and buy a company, and basically what it means is you're taking your equity capital from your investors, and you're also raising debt, and you're using leveraged buyouts. In essence, you're using leverage, i.e. debt, to buy out a company, buy a majority of the company that you own. So that's really at a high level. The way in which we look at the deals, oftentimes from a valuation perspective is what's called enterprise value. For those who aren't familiar with that, it's the debt plus the equity less the cash on the balance sheet. And so when we look at a company, there's an overall value that we need to pay for the company. And then the sort of the dance that you do is, well, how much debt can I get or leverage can I get on the company? So I put in as little equity as possible, because our job is to return as much money to our investors while putting as little of their money at risk in the process. So, 5 or 6 years ago, it was pretty common to get, a multiple of your profitability or cash flow. You could get 4, 5, 6 times in debt. And banks, a lot of times when they're lending you money, didn't really care how much equity you put at risk. And then the recession happened, and that has changed dramatically, where, what we see typically now is, it's coming back around, but 50-50, that if you're going to get 20 million, and you guys jump in if you're seeing something different, but if you're going to, let's say you're buying a company from $100 million, and banks could say, well, I could give you 80 million, but I'm only going to give you 50 because I want you guys to have, and what they use is a stupid thing called Skadden the game, if you've heard that, right? They want to make sure that you have enough at risk that you actually care, and that, if things go south, you're going to work to fix the company. So that's an LBO. There's another type of loan called an asset-based loan, or an ABL, and that's basically where you're getting an advance rate against the assets of the company, and typically that's your inventory and your accounts receivable. And so you'll typically get, really, really roughly 85% advance rate against your accounts receivable, 50% against your inventory, and then you have what's called a borrowing base, where on a either daily, weekly, or monthly, or quarterly basis, the bank will make you submit a certificate, and then you're calculating the assets that you have, the inventory, the AR, and then that is a fluctuation of the amount of debt that you can have on the company. A cash flow loan is exactly what it sounds like. The company has a certain amount of cash flow, and you're getting a certain multiple of that cash flow is debt. Growth capital is a different type of strategy that's typically a minority, where you're not buying more than 50% of the company. You're putting it in equity, the equity staying on the balance sheet. It's also saying, it's staying as working capital. For those who are familiar with working capital, it's the technical definition is your current assets less current liabilities. So basically it means is the amount of money you have for operating cash to run the business on a daily basis. So if you have a company, and this is much more prevalent in in the Silicon Valley venture capital world, but growth capital is sort of a broader term. If you have a company that's looking to buy another company, and have a growth opportunity or something like that, they'll go out and raise growth capital. And then the dance that you sort of play is what's the value of the company and how much is the investor going to get, how much percent ownership of the equity is they're going to get for the capital that they're putting in. And then I won't go into distressed and special situations too much because I think he's going to go through it in more detail. But
Rick, if I could ask you, what role does the lawyer have, if any, in the investment strategy planning or advising? Where do you participate in that?
Well, it's less about which of these categories to go into, and the fund is raised with a particular strategy in mind. That's how it's sold to the investors. So, a single fund family, there may be several funds that have different strategies. You can have one that is focused on mid-market, small market, one that's growth capital, one that's a more traditional leveraged buyout. And as long as there's a coherent way of allocating the yields between them, you can have one fund family with several different investment strategies. Other than, I would say, and David probably does a lot of this, helping them define what goes into what bucket, right? And really trying to, with as great a precision as possible, eliminate there being a conflict around a particular deal. The fund comes to the lawyers with the strategy, and it's up to the lawyers to keep that strategy in mind when executing this particular investment transaction.
David, how about you? When you're papering the deal at this point, what are the issues that you've come across in practice?
Papering the deal or papering the formation?
I apologize. Yeah, in the investments, when the client comes to you to talk about, as we're talking about the investment strategies, what's your role at this point?
I think Rick is right, because when the client is coming to you, he's raising a fund for a specific purpose. It's a leveraged buyout fund, it's a distressed fund, but there is a specific strategy that he's going to be marketing to the investors. And so the structures for some of the underlying the fund for each of these strategies will have minor changes, but ultimately, because from the marketing standpoint, it is kind of by the time they come to you, they already decide what they're going to do from a strategy perspective. But from a deal perspective, and let's say it's a buyout fund, they come to you with a deal. There, I guess, and Rick can talk more about this. Then there's about how you structure a particular deal, how you structure a particular buyout, how you structure a particular minority investment in a company. There's a fair amount of variation in that, and that I think is the area where the lawyers play a much more significant role in helping define what the actual transaction, what the actual form of investment and the terms of the investment look like.
Let's move to leveraged buyouts and talk about them specifically for a little while. And Rick, if I can come back to you to speak to the LBOs.
So, as was mentioned earlier, leveraged buyout is essentially a buyout with leverage. How much that leverage is depends on the type of company. I mean, one of the reasons you don't typically see huge public, LBOs of, say, internet companies and the like is that one of the key aspects of the PE fund is that there has to be cash flow. And so if it's a tech company that has a lot of cash flow, it's a prime target. If it manufactures ball bearings, it can be a key target. The key is really what the cash flow is, because at the end of the day, what they're looking for is enough cash flow to service the debt that they're going to put on the company. So they come in, they find a company, maybe it's public, maybe it's private. You basically have a lot of situations where there's a founder, he or she is getting up there in age, needs to figure out a way out of this company, is looking for a liquidity event, and lo and behold, a private equity fund can be an excellent way to create liquidity there. Similarly, there may be a public company that, for one reason or another, management, doesn't think, or the fund doesn't think is being fully valued in the market. And so they see an opportunity to come in, buy the company, take it private, use leverage to pay a portion of that, and then, do whatever they think that the company needs to more clearly show its value, and then turn around and either take it public again, or sell it to a strategic buyer, or maybe a private equity fund. Management-led LBO or an MBO is sort of kind of the reverse. The management says, hey, we'd be much better off being private. You know, we're not getting the right price here. We need to be out of the public eye to execute the following strategies, because if we are subject to the quarter by quarter, you know, hit of the fact that we're going to be losing money for the next year or 2 years while we execute this grand strategy. So they go out and often try to find the PE fund, partner with them to take the company private. The fact of the matter is, though, almost all LBOs are to some degree involved with management, because private equity funds, you know, are not companies. They don't have somebody who knows how to run this company necessarily. So they are depending on management of the company after the acquisition to execute the strategy. Now they might have some ideas, hey, I want to take out the CEO and put in this new guy or what have you. But by and large, there's most of the time we deal with management in connection with taking the company private, because they need them to run the deal. You know, risks of over leverage, I mean, you know, it's pretty obvious. If you get the calculus wrong, and in fact, something happens in the market, something happens to the business where the cash flow can no longer support the leverage that's been put on it. You know, the great thing about leverage is if you do it right and you increase the value of the company, every dollar of value you create in excess of the interest rate redounds to the equity. That's why you use leverage. The bad news is if you get it wrong and there's not enough, then you have a lot less room for error in how you run the business, and it ends up going into a distress situation. And you know, you'll be talking to a lot of distressed players about banks or other lenders potentially owning the company going forward.
Ken, one second. Ken or Chris, if you could speak for a moment from the business perspective, how worried are you about fiduciary obligations and these LBOs and MBOs? When you're talking about setting prices, et cetera, valuing the business, are you seeking the lawyer's advice out ex ante, or do they come to you afterwards and say someone's going to sue us over this, or what are the lawyers intersect with this?
Well, this is probably more we're normally not managing the companies in the mind, so.
We worry about it a little bit. We have insurance, so. But no, seriously. You know, the fiduciary obligation that I worry about more is the fiduciary obligation on investors, to be totally honest. And it's, you know, if it's a deal and you shake hands with the guy and you do a deal, very rarely is someone going to come back and challenge the value of the deal. But where we're very, very careful is in the dealing with our investors and kind of the, you know, the reporting to them and the accuracy of that reporting and what we're telling them to make sure that we, you know, we're doing everything properly and the way we're calculating our fees and expenses is proper. And, you know, you never really think about it until a deal goes bad, and then people do get sued over these things. We're fortunate enough we haven't, knock on wood, but you know, I know a lot of situations people get sued over things like that. We just need to be careful.
Well, and to be clear, the private equity fund doesn't owe a fiduciary duty when it's trying to buy it. Their job is to get the best price they can. Now, they may be teaming up with management who owes a fiduciary duty. The problem with our system, when you're buying a public company, is you will always be sued for aiding and abetting the breach of the management's fiduciary duty or the board's fiduciary duty. And so most private equity funds, as I think we just demonstrated, view it as a cost of doing business. I mean, you know, you save some of your purchase price because you're going to get sued. You're going to need some money to settle the lawsuit. It's almost a transaction tax that's been established.
That was leverage buyouts. Anything else you guys want to add about LBOs or MBOs process? Let's go to distressed debt financing, which is, catch up here for a second, the last slide. And Chris, do we have you speak to this one?
Yeah. So we mentioned the risk of over leverage. The main risk is that then it goes from Ken owning the business to us owning the business. And these are largely the situations that that type of thing takes place where, so Tennebaum's known as distressed debt or special situation fund, even though now we actually do have separate investment funds that lend to healthy businesses and companies that we have no desire to own. And, you know, we just want to collect our coupon and be cooperative with everyone and have it work out well for you know, the sponsor and the management team. But there are certain situations where you know, the sponsor has already bought a business, they've over-levered it, and now the plan has not gone as well as they were hoping. And so in those situations, we'll go in and either provide new liquidity to the company in a rescue loan, or we'll just go in and buy the existing bonds or bank debt at a significant discount. You know, you can find many bonds that are trading at 40, 50, 60 cents on the dollar, and it's assumed that you're going to go in and buy those, and you will be taking over the equity and running the business once that goes through a restructuring. So I guess just to go on the slide, you know, we do provide financing to firms like Ken's to go out and buy a company. If you're going to buy a company, say, you know, some industrial company, maybe you're going to pay 6 times for that. If you went to Bank of America or Wells Fargo, they're probably only going to lend you enough debt to, you know, maybe pay, and by the way, when I say times, I'm talking multiples of EBITDA. And so if you're going to pay 6 times EBITDA or cash flow, then you may be able to get some nice low-risk bank debt from a traditional financing source for, you know, maybe half of that purchase price at most. And then generally you're going to want to juice your equity returns a little bit more. So that's where someone like us would come in and provide what they call stretch financing and go a little bit riskier, and therefore, you know, that's it could be either bank loans, like a second lien term loan, or bonds, often referred to as high yield or junk bonds. And you know, we're taking a riskier position where we need the senior financing piece to get paid out before anything would come to us if, you know, the plan goes wrong. And for that, you know, we're typically looking for, on a new syndication like that, somewhere in the range of 10 to 15% returns, whereas the equity sponsor is generally looking for something, I would think a minimum of 20 to 25%, probably often much higher. Then, you know, so that's where we get in directly and loan money. Otherwise, we'll just be buying existing debt that's already, you know, been provided to the company, and the lenders who provided it are now getting concerned, want to get out of their position. We'll go in and buy it at a big discount and hope that either the company turns around and we get out at par, you know, 100% on the dollar, or if it doesn't turn around, we'll get active and lead the company through a restructuring, take over the company, and hope that we can put in new management that will do a better job the second time around. So those are kind of the two strategies that we largely employ at the firm, and so, you know, given the risky nature of some of these investments that we're making, it takes a little bit more of knowledge about just the legal construct of going through a restructuring, going through a bankruptcy. And so while we do deal with the law firms in structuring our initial deals, I see that as more of a simple exercise, you know, just basically drafting the credit agreements or the indenture, intercreditor, all that type of just kind of standard language, and then tailoring it to our specific situation. Where we really get involved and generate just a huge amount of legal fees is when we take companies through bankruptcy and or a messy restructuring, which you'd be amazed how messy some of them can get. So, you know, I had one portfolio company that was in restructuring and in default for 2 years, which the attorneys just loved that one. Luckily, they actually did turn around in default, and we ended up, you know, we were buying that debt at 40 cents on the dollar at one point. I think our average cost was 60 cents. Ended up getting no coupons or anything for 2 years. And then, after the downturn, things started just rocketing back, and ended up getting, full 100% on the dollar, plus all the accrued interest over the 2 years. So that's obviously the great scenario where you end up making a lot of money, and everything works out well. It ended up not being so messy. That was all out of court negotiations, and we never filed formal Chapter 11 or anything. So getting to the deal terms, that's kind of what I just touched on, in court versus out of court, whether you go through a formal bankruptcy process or not. Typically a Chapter 7, or typically a Chapter 11. If it gets real ugly, then you go Chapter 7. And that's when you definitely want to be more on the asset back side, something like an ABL, to be a little bit more protected. A lot of times, even if you look like you're going to go for Chapter 7, someone will come in and buy such large pieces of the company that it ends up almost being like a reorg, because it's just a strategic coming in to buy large chunks of the business, and you get paid out, and you don't have to run the business on the exit of bankruptcy. Fulcrum security is what we look for if we were, so our newest fund that we raised in 2010 was a loan-to-own fund, which I'll get to next. But so essentially that one is looking for companies that are distressed and basically the equity's already been wiped out. The debt's trading at 50 cents on the dollar, and a lot of times you'll have multiple tranches of debt. So like the first example I gave, you might have, if someone's buying the company for 500 million, they might have 200 million of senior debt, 200 million of junior debt, and 100 million of equity. So if you look at the company and say, well, now it's worth 300 million, then the 200 of senior debt is fully covered, money good. The junior debt is only 50% covered, so that would be considered the fulcrum security, where value goes into the class, but it doesn't fully extend through the class, and therefore they are getting impaired in a restructuring, whereas the senior debt in that case wouldn't be impaired, and so generally they aren't going to get much of the equity, if any. You may be able to just refinance them out completely. So we would look for the fulcrum security, go in and buy that $200 million tranche, assuming that it's got the 100 million of value extending through it. You pay no more than 40 or 50 cents on the dollar, and then in the restructuring, either in court or out of court, you'd expect to come out with the majority of the equity, and then you'd be owning that business and putting in new management, and you're trying to turn things around, get it back up to the value that the sponsor bought it initially, and then obviously you made a nice investment. So those are kind of the highlights of the distressed debt side.
And in the justification for the lawyers, the reason that there's so much legal work involved in the restructuring area and why it becomes so complicated is because it's really zero sum in this scenario, right? I mean, everything that you find, if you can find a way to turn a position, it can substantially change what the recovery is. And so there's a lot of game theory that goes on. In restructuring, we spend a lot of time figuring out what's this guy going to do, what's that guy going to do, et cetera, because it's easy to say, well, here's the fulcrum security when you assume what the value of the company is, but that's not always clear. I mean, if you get it wrong, you buy the wrong security, you could get taken to cleaners. So there's a lot of work that goes into figuring out where's the best place to be in the calculus.
Rick, is that transactional type planning? It's a very complex deal, so it costs a lot of money to have lawyers to negotiate this out? Or is there litigation going on at the same time? Is that what drives the cost up?
Well, there could be litigation going on at the same time. I mean, a lot of times you take a look at this and you say, well, my covenant says this, and I believe my covenant stops you from getting paid. The other person may read his words and say, no, we think he does get paid. And you have a big fight about it, right? Or you could do a consent solicitation with a friendly group to help get a deal done, and ends up, putting it over on another group of creditors, and they'll fight you on it. The reality case is a good example of that. So, getting, there could be a lot of litigation. One of my partners once said to me, the only way to make bankruptcy cost less is to do it more quickly. And so when we're representing the companies, we favor pre-packs. We try to get in and out of bankruptcy as quickly as possible because it's a process that just eats up an enormous amount of time.
In just a few moments, we'll open this up to questions. I just want to ask the panelists, each of you, just for a moment to speak on the trend in the industry. Where is it heading? Where's the LA private equity market heading in the short term? And nationally, where's it heading? And the related question is for the people sitting up here, where are the jobs?
On the fund formation side, especially with Dodd-Frank being passed, prior to Dodd-Frank, most fund managers were unregulated, and they liked it that way, which also made it much more easy for a new fund manager to start up a new fund. Now with Dodd-Frank in place, all private equity managers need to register as an investment advisor. There's significant cost of registration, there's significant cost of compliance, and as a result of that, it is much more expensive to start a fund. You tack on to that, the last 5 years where the economy has not been doing well. A lot of funds have failed. Some funds, especially the bigger ones, have been more successful. And so what you see is a combination of increased cost in raising the fund, as well as a flight to quality by investors. And as a result of that, it's a situation where the existing fund manager, the big, strong fund manager, the Carlyle, they are in the world, they get bigger and bigger and stronger and stronger. Whereas the more entrepreneurial startup funds have more difficulty in raising capital. Now that's not necessarily true in all cases because your track record as a fund manager is basically what you're marketing on. But as a general overall trend, you do see the institutionalization of the private equity world.
Well, I'd say Los Angeles is definitely a middle market, PE market, and it's moving ever more so that way, I think. I'd also say to David's point that the 2008 to present has really shaken up the area a lot. And so a lot of the smaller players, they're not funds. There's less what I'll call discretionary capital, but more individual investment. You go out to, you may know a lot of LPs. You may have, maybe you didn't survive unscathed out of the Great Recession, but you can gather LPs around specific investments. So they're sort of mini funds, being formed around acquiring particular companies on the smaller side. And I think even the larger guys are having a harder time raising the sizes of funds. And there's more and more of LPs saying, I'll give you X dollars, but if you see something really big, come talk to me. Maybe I've got a co-invest that I'll write alongside. I want more say on my exposure to particular issues.
Okay.
Yeah. One of the issues that we're focused on, and it's been in the news a lot, and I think with Governor Romney's candidacy, I think it's been thrust after a little bit more, which is the taxation issue around our profits. So the way we get paid is we get fees that we call from the fund, and then monitoring fees from our companies. But we also, the way you make most of your money is through your carry, or it's called your promote. And the typical structure is once our investors' money is returned plus some sort of preferred return, typically 8%, then we get 20% of everything after that, which is the carried interest, carry, promote, and that's typically taxed at capital gains historically. And there's been a lot of groundswell over the last couple of years about changing that to ordinary income, which is bad.
I would have thought you guys would have paid Robin, not to Robin.
Yeah. So there's a lot that we focus on, and that's certainly a major trend. And I think a lot of lobbying by the very, very large private equity firms, which I think kind of quashed it. I think around a year and a half ago when it almost passed. But that's going to be certainly somewhat dependent on who wins the election, but a key issue out there for the private equity community.
And for those in the room, capital gains is the right taxation. It is an equity interest. It's not any different than selling any other equity, just to get paid on any other equity interest. even though the press would have you believe that they're somehow getting away with murder.
You're talking to a liberal professor, by the way, so I may have a different view, but we'll let it go.
Yeah, so, your timing is relatively good. It would have obviously been nice to be in private equity in 2005 through 2007. Unfortunately, I was in banking at that time, so it was okay too, but at least you're not coming out in 2008 or 9. And so, as I mentioned, you've seen a lot of funds close down, and there was far more supply in the industry, both from legal restructuring side, legal just corporate finance side, and then certainly on the fund side. But it seems like now, capital raising has gotten slightly more favorable, and at least, based on what I'm seeing in the LA market, I feel like hiring has picked up a little bit more, and you're starting to see people look to raise funds again, and just start new funds, which makes for a more exciting environment. There's a lot more people leaving who may have shut down and gone to join a huge, since I'm on the credit side, join a huge corporation like PIMCO to have the stability to get through the downturn, and to not have to worry about seeing their carry, that they were hoping to get. Their fund just lost 30%, and they've got to get that 8% promote before they see anything. And so once you're down 30%, getting back to be up 8%, and oftentimes that's annualized. So if you're 3 years down, you have to get way more than 8%. And so people are just shutting their doors because they said, I can't sustain a fund and promote the right people that I need based off a 1.5% to 2% management fee. So a lot of those people went to bigger funds or just large institutions, even back to banking, as painful as that seems like it would be. And now you're starting to see a lot of those people. I think there was just an article in the Wall Street Journal a month ago or something talking about a lot of the real senior guys at PIMCO breaking off and starting their own funds, and kind of creating a whole resurgence in that area in Orange County and LA of all these new startup funds. You've seen some of the similar things that people coming away from Capital World and starting new funds. So it's definitely picking back up, and I think that obviously generates a lot more need for on the legal side, and just if you want to go work directly out of fund, I think there's going to be more opportunity over the next few years.
One more thing. So I think one of the big questions is how do you get a job working in private equity to the extent you want to, right? I think there's no one answer. I think the stereotypical route is you go and get your MBA, you work at a bulge bracket bank on Wall Street for a couple of years, and then transition into private equity. That is sort of the historical path. I'm a lawyer. I don't have an MBA, so I went to school here, worked at a law firm for a couple of years, switched over into the legal department of a private equity firm, switched over to the business department, business group at the private equity firm, left and founded my own firm. So that's the path. My partner has an MBA. The guy who works with us is a JD with an LLM. So there's no one path. I think if you're interested in getting into private equity, I think the key thing is getting exposure to private equity, meeting people who are in private equity. Private equity in Los Angeles, both legal and business, it's a very, very small community. It's not like New York or Chicago or Boston where there's a lot of it. It's smaller here, which means it's a lot more relationship based. So if you are interested in working in Los Angeles in private equity, I would just recommend that you get out there and try and meet people. I can certainly be of assistance there if people want to reach out to me directly and talk about it. I'm happy to talk, as I'm sure everyone else is here. But it's just, if you're a lawyer sitting here saying, how do I do this if I want to do it? There's a path, and very successful people.
You'll have 200 resumes tomorrow.
Yeah.
I guess from at my firm, I've seen something similar. As I mentioned, I actually went to undergrad here, and then I worked at Goldman and then Credit Suisse, and then went to Tennebaum. But we do have a lot of people, given that we are so focused on bankruptcy law and going through restructuring. We do have several attorneys on our staff to help just navigate that whole process. And so generally they worked on the restructuring side at a law firm, and then we'll hire them on and they'll come in and help us directly. It's obviously much cheaper to have people that are just on a salary than billing us at $1,000 an hour. And so, I think we've got, I think, one of the partners of the fund got his law degree here at USC, and he was one of the founding partners. So he had partnered up with Michael Tennebaum, who started the fund early on, and got a pretty good role just by getting in very early. And so, for all the new funds that are coming out, to the extent that you've done a couple years of restructuring law or on the documentation side, I mean that seems like it would be a real great opportunity if you could find it to then go to one of the new kind of starting out firms, get in early, and then if the firm performs well, it'll be all set.
What questions do you guys have? Someone's got it. Sir?
So, Tennebaum does distressed assets. What space do you guys normally focus on? What
Industry?
Yes.
So we do every industry other than real estate. Because of our fund structure, we can't take over a business and own real estate directly. We raised our funds largely through Latham's Skadden. So maybe they could tell you why that is. I have no idea why it is, but apparently we can't own real estate. So given that we're often taking companies over, that takes out the real estate companies. But every other industry we're generally following. I personally cover the more asset-heavy industries like metals and mining, industrial, manufacturing, aerospace and defense, and some transportation.
Do you do on the buildings that, you can't own the buildings that, or the factories or anything like that?
Yeah.
Well, you can own the real estate as part of an operating business.
Yeah, we can set up like corporations that own real estate and own it through like a blocker corp or something, but it gets a little bit messier and less tax friendly, at least what I hear.
Real estate is a separate asset class. The primary reason that when the investors in these funds they're making their decision to invest in private equity fund, they have in mind a larger macro asset allocation. So they're going to put some money in equities, bonds, private equity. So they've already calculated internally what they're going to invest in real estate. And so they want that exposure through their real estate investment. They don't want real estate exposure through the private equity.
That makes sense. Thanks.
What's the process when you go to replace management? I guess when you kind of fall into an active position in owning the company. I mean, is there kind of like a Rolodex you could have of managers that you feel are best suited for the job, or do you sponsor kind of a corporate search, or how
Yeah, so it's largely, we'll obviously know a lot of managers. We've got an advisory board that has various people that are experts in all the industries that we cover. So we'll go to them for recommendations, and then we'll generally use a headhunter to just go out and recommend some additional candidates. One of my colleagues was in New York yesterday interviewing CEOs for a gaming company that we had taken over. And so, that's the most difficult part, I think, of going through restructuring is obviously, all the negotiations are pretty painful, but finding the right CEO who can actually turn it around and cause you not to continue burning cash and just make your $50 million investment, $80 million investment over, the next 2 years of emergence. That's a real key thing. It's more of an art than a science, picking the right CEO to turn things around.
And what I've seen a lot of recently, which I hadn't seen 5 years ago, is management in search of a company. So private equity fund will basically, manage somebody who's, hey, I know everything there is to know about industry X. Here's my track record. Maybe their last company got bought out and exited, and now they are sitting on a bunch of cash and don't need to work for a living. Invest in me. I'll go find businesses in this space, buy them, run them. It's sort of a roll-up strategy, and you basically they get kind of their own carry, and they go out and try to find businesses within their space. And sometimes they're successful, and sometimes they can't find the right targets.
That has been a big trend too, just for management teams partnering with big private equity funds. You've seen Ares, Apollo, a lot of other big funds are basically taking a few smart guys that either know, airlines, shipping, and saying go out and, shipping is incredibly distressed right now, saying go out and start buying ships, either lease them out on the spot rate or, put them on long-term charters and build up this huge portfolio of ships or aircraft for sale leasebacks. That's been a very popular thing just over the last couple of years.
Yes, given the current leverage loan and high yield markets and the pickup in CLOs again, do you see distressed debt opportunities going for fiscal year, and how are you positioning yourself?
It's horrible right now. There's so much easy lending out there where guys like Ken are probably just getting covenant light deals that are junk bonds for like 7%. It's a great time to be on the equity side. From my perspective, if we want to put money to work, we're taking relatively what I would consider riskier companies and making 12% loans, which even in this environment, 12% is hard to find. I just closed a 20% loan. We provided $100 million of debt at a purchase price of 75 cents on the dollar, just because there were no other lenders who would step up to do that. A lot of Middle East exposure there. Libya had been a huge disaster for them. And so obviously very risky. I mean, that company was on the verge of bankruptcy, probably. And those are the kind of situations we have to go into now to get 20%. And so, I'm looking forward to the next big recession. I mean, in 2009, I was getting companies that you were completely covered by the assets, very safe, and there was huge margin for error, and getting like 25% returns on first lien, top of the capital structure, most senior debt on the company, and you're covered, you're buying in on a normalized cash flow basis for like 2 times. And it looks like 6 times now because their earnings have plummeted. But then a year later it ramped back up, and I mean we're buying in for 60, 70 cents on the dollar and getting out at par like 10 months later. It was great. So I'm looking forward to the next one.
What a lot of people don't realize is a lot of times the difference between a healthy company and a distressed company is not the business of the company. It may remain the same. It's the lending standards at the time that their debt becomes due.
Yeah. Yes, sir.
In terms of the attorney's role beyond kind of fund formation and getting into kind of acquisition of portfolio companies, I've heard that first year, second year associates, a lot of their work is going to be diligence memos, things like that, and quantifying legal risks for the client so that they can kind of stick it in their models. Now, I mean, I guess how true is that, and how do you quantify legal risks for the clients?
A lot of the deal process is actually structuring and negotiating the deal. In terms of quantifying legal risk, I guess. I'm actually not sure what that actually means.
Yeah, lawyers don't like to quantify risk.
The way that I look at it, having practiced law for a while and now no longer actively practicing, is the way I like to look at it, I guess, every issue in a deal is an assumption of risk issue. And when it comes to an item of legal risk, I get my arms around it, and then I put a dollar value on it, and I try and knock purchase price off of the deal to assume the legal risk in an amount that I feel is sort of the discounted value exposure. And having a legal background and being able to do that is extremely helpful, and working with good legal counsel who can help work through those. And that, in negotiating the documents, that's really what it is. There's exposure, right? Representations and warranties. It's allocating risk of things that happened in the past. Covenants is allocating risk for performance you're agreeing to do in the future. And all of that has a legal component to it, and all of it has a business component to it. And the business component to it, if you can quantify it and put a dollar value on it, then you can use it to your advantage in the transaction.
I think a good way to think about it is, imagine that you're going to buy my car. there's a couple of different ways you can structure it. You can at one level say, I'm going to sell you my car, it is what it is, and then you're going to come up with a price for that. Conversely, we're going to have you have a detailed inspection of it. You can have me promise that all sorts of things with this car. Like you can have me give you a warranty, and depending on how much protection you get, how much risk you're willing to assume, the price will be very different, and the structure of the deal may be very different. And when the private equity folks are doing these deals, and there's a lot of variables without plan. There's a lot of different ways that you can actually handle each one of the risk elements.
It's also helpful to the buyers if their attorneys find something that looks real risky. Like I'm selling one company right now that has some environmental contamination. It's unclear whether it's ever going to end up in litigation because it's gone on to another person's site, but it's unclear whether they are aware of that and whether they care. So the buyer's attorneys are obviously going to be pointing this out to them and saying, well, here's your risk if this does get litigated, if this ends up being a huge disaster a few years down the line, our attorneys are saying make sure you structure it as an equity sale rather than an asset sale so that they take all the risk with them. They're of course going to want to structure it where they're not taking that risk. So it ends up, you go somewhere in the middle. We'll probably do it as an equity sale because that's the only way we're going to sell it. But we'll probably have a large holdback where, if no claims taken place for, 3 years or something, then we'll get, 20% of the proceeds will be held in an account. And after 3 years, if no claims have arisen, then that'll be returned back to us. So it's the attorneys that help to decide how big those baskets should be and how much risk there is. Although they'll never tell you, they just say it depends. And it's very hard to get clear.
What you love as a lawyer is something that has a really high magnitude potential risk, but a very low probability of it happening, or some way of dealing with it. Because then you can go to the seller and be like, oh my God, we could lose our shirts if this happens. You've got to cut the price by some large percentage of what the potential exposure of this is. Meanwhile, planning and structuring on your side to minimize the chances that you'll ever have to pay that, right?
Sir.
I'm a 1L, and obviously the amount of legal education that I've had to date is rather limited, although I have actually worked in finance before. What I'd like to know is, what would be your advice in terms of seeking out unpaid summer internships? What could we expect to find? What should we look for? Is there much in this space that would potentially be available for us, or would you say go do something else and then talk with us next year?
I mean, from the legal side, it's tough. The number of 1L summer jobs is low, and most law firms, don't have a, well, it's okay if you work for free program. Right? So at the end of the day, market was somewhat the same when I was 1L. I went and worked for a judge. There's almost nothing that you can do that won't come up at some point. Right? I mean, any experience you can get, you'd be surprised at the breadth of things that you're going to see doing acquisitions. You'll find that I've used almost every class I took in law school at some point because you end up buying this company that does that or this other company. So any legal experience is good, but it's going to be tough to find an unpaid internship in most firms.
We've actually gone an hour, so we're going to let the panelists off the hook. However, there's a reception upstairs, so if you have questions, please don't go away. If I can indulge you guys, please come upstairs with us and introduce more questions. So come on up, guys.